The following podcast was recorded on Tuesday, February 14th, 2023, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim answers the question, will the Fed hike beyond 5.25%? Things are on the move regarding the Fed. Month over month, CPI came in as expected. Year over year data was a bit above estimates. The market is starting to price in more than 5.25%. Jim, what are your thoughts?
Well, I was going to say, let's make this the world's shortest podcast. Yes, they are. Thank you, and drive home safely. But I think people are here for more than just that. So if we jump to the first chart, I do want to emphasize something that you just said, that the market is starting to price in more than what the Fed has suggested. So this shows you the forward curve, this fancy way of saying what is the market pricing out in the future. And that stair-step blue line is what the Fed has been communicating between their dot chart and some of the speeches that Powell and others have been giving, that they've got 2 more 25 basis point hikes to get the funds rate to 5 to 5 1/4. So that's why the line is horizontal there at 5 1/8, halfway in the midpoint between that. And then there's an orange line and a green line. I'll start with the green line. The green line is where the forward Fed fund futures, what the market was pricing in on February 2nd, the day before the 517,000 payroll report. And then the orange line is today post CPI. That is an enormous change in 9 trading days that we're seeing with the market, that it is pricing in maybe 3 more rate hikes than it was just 2 weeks ago. And you could see that the orange line goes well above the blue line, meaning that the market is starting to price in something more than what the Fed has been communicating. And this can be seen in the next set of charts. So if we go to the next chart, we know I left off the chart for the March 22nd FOMC meeting. That is pricing in 100% probability that the Fed raises rates 25 basis points, and has been since February 6th. So that's locked in at 100. So we know that. Now, assuming that the Fed moves 25 basis points at the March meeting, what is the May meeting pricing in? An 83% chance that they raise rates again at the May meeting to 5 to 5 1/4. That's the Fed's communicated target. But if we jump to the next chart, this one is what is the market pricing in for the June meeting, so 2 meetings out, assuming 25 and 25. So assuming we're at a 5 to 5 1/4 rate, and it went above 50% today post CPI, because as you pointed out, CPI beat expectations. So it's at 52% now that they're going to raise again to 5 1/4 to 5 1/2. And I might add that 9 trading days ago, this was at a 2% chance that the Fed was going to raise rates beyond 5 1/4, and now it's at a 52% chance just in 9 days. So there's been a wholesale change, especially like the first chart showed you with the difference between the 2 curves. There's been a wholesale change in the thinking about the Fed in just the last 2 weeks, now opening the possibility that the Fed will go more than just the 5 to 5 1/4. Last, I don't have a chart on it, but there's also stories that if you look in the SOFR futures, remember SOFR is going to replace LIBOR in April for the short-term interest rate futures contract, because LIBOR is going away. And the SOFR 94 strikes, so the 6% interest rate for September has been exploding in open interest. Everybody is making bets that the Fed will get to 6% by the fall. Now, that doesn't mean it's going to happen, but it does mean something that wasn't even existing 2 weeks ago or 3 weeks ago, that the market is starting to place bets that not only the Fed's going to go beyond 5 1/4, but maybe as high as 6 by the fall.
What do fund managers think?
So this is one of these rare instances as we jump to this next chart that the market is now ahead of where fund managers are. This comes from the February Bank of America Global Fund Survey, which I might add is out the same day we're reporting. We're reporting on Valentine's Day, February 14th, and this came out this morning, this survey, 300 global fund managers. They asked them what is going to be the peak funds rate, and that's the dark blue line. The light blue line is January. So over 50% of them think the Fed's going to stop at 5 to 5 1/4, their communicated goal. The second largest one is 5 to 5 1/4 to 5 1/2, and then the third one is 475 to 5. So let me bottom line this for you. 75% of the managers think the Fed goes to their goal of 5 to 5 1/4 or less. 25% of the managers think that the Fed might go to above 5 1/4. So the market is starting to price in more than 5 1/4, and only 1/4 of the managers on a survey released today is suggesting that they are there thinking that as well. If we jump to the next chart, this shows you when they think the Fed is going to stop raising rates, when we're going to hit the terminal rate. May 3rd, the meeting after the next meeting is the biggest choice. Then June 14th, March 22nd. So a lot of these managers are thinking that in the next 3 meetings, the Fed will probably raise twice and be done. But beyond that, there really isn't this thought process out there among the managers like there is in the market that the Fed might keep going until the fall and maybe hit 6%. Again, it doesn't mean the market's right. It means it's starting to price in a scenario that the broader investment community is not adopted yet. Maybe they don't adopt it. Maybe these fund managers never come around to the thinking that the Fed goes beyond 5 to 5 1/4. Or maybe what the market, and this is my interpretation, the market typically leads. The market just got there literally today. There'll be, the Kluber-Ross five stages of grief. They'll be ignoring it and then mocking it, and then there'll be bargaining, and then finally there'll be acceptance of this idea that the Fed can keep going along. So the fund managers will usually lag. So this is a rare situation where the market has jumped ahead of the fund managers. Fund managers aren't there yet, but I think that as we move forward, they're going to get there.
How does inflation fit into this?
Yeah, so this brings up the next question is, okay, why is the Fed going to go beyond 5 to 5 1/4? Now, there's 2 reasons. The first reason I don't have any charts on because we've showed these many times is the obvious reason. The labor market is very strong. That's the obvious reason. 517,000 jobs, a 3.4% unemployment rate equaling a 70-year low, under 200,000 initial jobless claims for the 6th week in a row. Usually sub 200,000 is considered boom territory, not slowdown territory. 11 million open jobs according to the JOLTS report, 1.9 open jobs for every unemployed person, all just a smidge off of an all-time record. The problem with the labor market is there is no problem with the labor market. And so therefore, if the labor market doesn't have a problem, the Fed doesn't have a reason to cut rates. That's the obvious explanation. The less obvious explanation coming out of today's CPI report is we're running out of runway. And what I mean by that is if you look at this is the monthly CPI report. And in red, we highlighted the next 5 months of CPI. So you can see that next month for February CPI, which will be released in mid-March, we're going to drop off a 0.7, then we're going to drop off a 1%, then a 0.4, then a 0.9, then a 1.2. So unless we print 0.7, 0.1%, 0.9, 1.2, the inflation rate is going to keep coming down. But what we're pointing out here is that then look what happens with let me say, this is the so-called base effect that everybody talks about. What are you dropping off? What are you bringing on for the new numbers? And it is suggesting a big downward bias in inflation. But what happens when we get to July and August? Then you're dropping a 0, a 0.2, another 0.3, a 0.1. You're dropping very low numbers. The base effect then gives an upward push to inflation. So if we go to the next chart basically shows us the blue line is the actual inflation rate, and the red, orange, and green line is the inflation rate of various scenarios between now and June, whether we average the same inflation rate we had between 20 and 22, or the pre-COVID inflation rate, which is in orange, or in green. What if we just print 0 every month for the next 5 months? Mind you, we've never done that before in any scenario, printed 0 for 5 months in a row. But the more likely scenarios of the red line and the orange line, they don't even get you to 2% by June. Then this base effect turns around and it starts moving higher, and you could see the base effect then is an upward push on inflation. You could see it start drifting higher. And that's what I mean by we're running out of runway. If we were to get inflation down to 2% per annum on a long run basis, as the Fed is said, we got to be there easily be there with these positive base effects by the middle of the year. Doesn't look like we're going to make it. And then after that, the base effects turn north and they could see an upward drift. Also, if you look at the last 3 and 6 months annualized inflation rates, they are after the revisions because of the reweighting last Friday that we got. They're averaging 3 and 4%, 3% on a 3-month basis, 4% on a 4-month basis over the last 3 to 6 months. So we're not going to quite get to 2%. And what I want to emphasize here is the long-term average 2%. Yes, if we have a recession, if something breaks, crude oil goes to $50, we can get there. But then that's only temporary until the recession ends or whatever causes crude oil to have a glut, and then it turns around and it rebounds when that rebounds. But if we're going to organically get to 2% and hold 2%, we're running out of time here. And that's why I think there was this broad belief today we're running out of runway when it comes to inflation. The Fed likes to use a phrase called sufficiently restrictive. And they have said they don't believe we are yet at sufficiently restrictive. The marketplace kind of ignores that because they believe that we are. But what might be coming into the focus here is 5% on the funds rate is not restrictive. The labor market is fine. Housing and other interest-sensitive sectors, they're struggling, but that's not going to move the needle. Powell's been asked, you've been raising rates a lot, and housing's struggling. And he waved his hand. He said, yeah, you made a ton of money on your house in 2020 and 2021. You made a ton of money with the house appreciation. You're giving a little bit of it back. You're fine. So that's been his pushback about housing. So that's not going to move the needle. Labor is going to move the needle. If we're not seeing any problems in labor, Powell's going to say 5%, that's neutral. We have to get to sufficiently restrictive. Maybe we go to 5.5 or 6 and see if that then pushes the economy one way or the other. If the inflation rate doesn't make it to 2%, bottoms at 3-ish or high 2s in June and starts back towards 4 towards the end of the year, then Powell looks at it and goes, we're not sufficiently restrictive and we have to keep going beyond 5 and 5.25. That's what the market's pricing in. What the B of A survey is telling us and what some other metrics are telling us is a lot of market participants aren't quite there yet, but over the next couple of weeks, I think they're going to eventually get there.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions about Bianco Research, Arbor Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks everyone, have a great day.